Our next learning objective is to analyze the effect of plant depreciation or plant asset disposal. And so eventually a plant asset ceases to serve the company's need. The asset may wear out or may become obsolete. Before accounting for the disposal of the asset, the business should bring depreciation up to date. So the key to this is to measure the asset's final book value and record the expense up to the date of the sale. To account for disposal, remove the asset and its related accumulated depreciation from the books. If a plant asset is fully depreciated and is estimated to have zero residual value, there is no gain or loss on the disposal. The accumulated depreciation account is debited and the plant asset is credited. If assets are disposed of for no proceeds before being fully depreciated, the company incurs a loss on the disposal in the amount of the asset's net book value. The loss on disposal of equipment is reported as other income or expense to the income statement. Losses obviously decrease net income exactly as expenses do. Gains on these sales increase net income as the same as revenues. When plant assets are sold for cash, a gain or loss can be incurred. If the cash received is greater than the book value of the asset at the time of the sale, a gain is recorded. If the cash received is less than the book value, a loss is recorded. That's why we've got to be careful to ensure that the net book value of the asset is up to date and at the same point in time as the sale. So let's walk through exercise 722-A. Assume that on January 2nd, 2012, Vincent of Vermont purchased fixtures for $8,700 in cash, expecting the fixtures to remain in service for 5 years. Vincent has depreciated the fixtures on a double declining balance basis with an $1,800 estimated residual value. Then, on September 30th, 2013, Vincent sold the fixtures for $2,600 cash. Record both the depreciation expense on the fixtures for 2013 and the sale of the fixtures. Apart from your journal entry, also show how to compute the gain or loss on Vincent's disposal of these fixtures. First, let's compute depreciation using the double declining balance method for 2012. Since the fixtures were assigned a useful life of 5 years, the double declining balance rate is 40% or 2/5. For 2012, multiply the cost of the asset by 40%. For 2013, the beginning book balance of $5,220 is multiplied by 40% and then multiplied by 9/12 since the fixtures were disposed of on September 30th. The amount of depreciation expense recorded is $1,566. This results in a book value of $3,654 at the time of sale. The cash received is less than the book value, so a loss will be recorded. The entries related to the sale of the fixtures are shown here. First, depreciation must be updated for the first 9 months of the year. The second entry shows a debit to cash for the selling price because we've increased cash, and that's an asset. When we increase assets, we increase those with a debit. In addition, the accumulated depreciation related to the fixtures must be zeroed out. The loss computed on the previous slide is also debited. Finally, the fixtures account is credited for the original cost of the asset. Managers often trade in old assets for new ones. This is called a non-monetary exchange. The accounting for non-monetary exchanges is based on the fair values of the assets involved. Thus, the cost of an asset like plant and equipment received in a non-monetary exchange is equal to the fair values of the assets given up, including the old asset and any cash paid. Any difference between the fair value of the old asset from its book value is recognized as a gain. Fair value of the old asset exceeds the book value, or a loss where the book value of the old asset exceeds the fair value on the exchange. So our next learning objective is to talk about how we apply generally accepted accounting principles for natural resources and other intangible assets. Natural resources are long-term assets of a special type, such as iron ore, petroleum, oil, and timber. These resources are often called wasting assets because, in contrast to property and equipment, they are actually physically used up over time. The process by which this occurs is called depletion. Depletion is distinctively different from depreciation because it involves actually tracking the flow of a natural resource from its raw state through inventory to the extent not sold, to cost of goods sold, and some other expense on the income statement. When a natural resource is acquired or developed, the entity follows the cost principle, similarly to what was used in accounting for plant assets. When the asset is extracted, the entity follows an approach much like the units of production depreciation method to account for the production. If all the resource extracted is regarded as sold, as in the case of drilling and exploration company, the amount depleted is transferred directly from long-term assets to the income statement in the form of an expense, such as depletion expense. However, as in the case of an integrated oil company, one with both production and refining operations, if a portion of the extracted resource is not immediately sold, it becomes saleable inventory, which we know is a current asset. Then, as the inventory is sold, its cost is transferred to an expense such as cost of goods sold. For example, a company purchases an oil reserve and records the natural resource as a long-term asset. The company both drills for oil and refines it, so the company retains some inventory rather than selling all it produces. When the barrels of oil are extracted, the amount depleted is debited to oil inventory. When the oil is sold, the third entry is made. Intangible assets are long-lived assets with no physical form. Intangibles are valuable because they carry special rights from patents, copyrights, trademarks, franchises, leaseholds, and goodwill. Like buildings and equipment, an intangible asset is recorded at its acquisition cost. Intangibles are the most valuable assets of high-tech companies and those that depend on research and development. The residual value of most intangibles is zero. Intangibles fall into two categories: intangibles with finite lives that can be measured, or intangibles with indefinite lives. For those with finite lives that can be measured, we record amortization expense. Amortization works like depreciation, is usually computed on a straight line basis. Amortization can be credited directly to the asset account instead of using a contra asset account like accumulated depreciation or accumulated depletion. The justification for this is that at the end of the finite life of the intangible, there's nothing left that would be reported. For intangibles with indefinite lives, we record no amortization. Instead, we check them annually for any loss in value or impairment and record a loss when it occurs. Goodwill is the most prominent example of intangible asset with an indefinite life. It results when a company purchases the net assets of another company for more than their fair market value. Let's look at 5 intangible assets in more detail: patents, copyrights, trademarks, and trade names, franchises and licenses, and goodwill. Patents are federal government grants that give the holder the exclusive right for 20 years to produce and sell an invention. The invention may be the product or a process. For example, Sony compact disc players and the Dolby noise reduction process. Like any other asset, a patent may be purchased. Copyrights are exclusive rights to reproduce and sell a book, musical composition, film, or other work of art. Copyrights also protect computer software programs. Are issued by the federal government. Copyrights extend 70 years beyond the author's life. And it could be a composer, it could be an artist, it could be a programmer. The cost of obtaining a copyright from the government is low, but a company may pay a large sum to purchase an existing copyright from the owner. For example, a purchaser may pay the author of a popular novel $1 million or more for the book copyright. Because the useful life of a copyright is usually no longer than 2 or 3 years, each period's amortization amount is a high proportion of the copyright cost. Owners of a copyright must use judgment in determining a reasonable life over which to amortize the asset. Trademark and trade names or brand names are distinctive identification of a product or service. The eye symbol that flashes across our television screens is the trademark that identifies the CBS television network. You're probably also familiar with NBC's Peacock. Advertising slogans that are equally protected include American Airlines' AA Advantage program and Enterprise Rent-A-Car's We Pick You Up slogan. These are distinctive identifications of products or services marked with the symbol TM or R circled. Some trademarks have become a definite useful life by contract. We should amortize this trademark's cost over its useful life, but a trademark or a trade name may have an indefinite life and may not be amortized. And franchises and licenses are privileges granted by a private business or a government to sell a product or service in accordance with specified conditions. The Chicago Cubs baseball organization is a franchise granted to its owner by the National League. McDonald's restaurants and Holiday Inns are popular franchises. Businesses purchase the rights to sell particular goods or services and are in turn agreed to operate under the standards and limitations imposed by the franchising corporation. The useful life of many franchises and licenses are indefinite and therefore are not amortized. In accounting, goodwill has a very specific meaning. Goodwill is defined as the excess of the cost of purchasing another company over the sum of the market values of the acquired company's net assets. Net assets being defined as assets minus liabilities. A purchaser is willing to pay for goodwill when the purchaser buys another company that has exceptional earning power. Goodwill in accounting has special features as follows. Goodwill is recorded only when it is purchased in the acquisition of another company. A purchase transaction provides objective evidence of the value of goodwill. Companies never record goodwill that they create for their own business. Secondly, according to generally accepted accounting principles, goodwill is not amortized because the goodwill of many entities increases in value. Our next objective is to explain the effect of an asset impairment on the financial statements. GAAP, or generally accepted accounting principles, require that management of companies test both intangible and tangible long-term assets for impairment yearly. Impairment occurs when the expected future cash flow, which approximate the expected future benefits from a long-term asset, fall below the asset's net book or carrying value, cost minus accumulated depreciation or amortization. If an asset is impaired, the company is required to adjust the carrying value downward from its book value to its fair value. In this case, fair value is based not on the expected future cash flows, but on the asset's expected market value at the date of the impairment test. The process of accounting for asset impairment requires two steps. First, test the asset for impairment. If net book value is greater than estimated future cash flow, then the asset is impaired. If the asset is impaired under step 1, step 2 comprises computing the impairment loss. And the impairment loss is equal to the net book value minus the fair value. If an impairment loss is incurred, the entry in this slide is made. Both long-term assets and equity decrease through the loss account. Under U.S. GAAP, once a long-term asset has been written down because of impairment, it may never again be written back up should it increase in value. And so next we want to talk about how to analyze the rate of return on assets. Evaluating company performance is a key goal of financial statement analysis. Shareholders and trust managers with the responsibility of developing a business strategy that utilizes company assets in a manner that both effectively and efficiently generates a profit. The most basic framework for this purpose is return on assets, or ROA, which measures how profitably management has used the assets that stockholders and creditors have provided. The basic formula for the ROA calculation is shown on this slide. ROA measures how much the entity earned for each dollar of assets invested by both stockholders and creditors. Companies with high ROAs have both selected assets and managed them more successfully than companies with low ROA. To better understand why ROA increases or decreases over time, companies often perform a DuPont analysis, which breaks ROA down into two component ratios that drive it: net profit margin and total asset turnover. Net profit margin increases or measures how much every sales dollar generates in profit. Net profit can be increased in one of three ways: by increasing sales volume, or the amount of goods and services sold, by increasing sales prices, or decreasing cost of goods sold and operating expenses. Total asset turnover measures how many sales dollars are generated for each dollar of assets invested. This is a measure of how effectively and efficiently the company manages its assets. Asset turnover can be increased by increasing sales. keeping less inventory on hand, or closing unproductive facilities, selling idle assets. ROA, or return on assets, is the product of the net profit margin and asset turnover. By influencing the drivers of net profit margin and total asset turnover, management devises strategies to improve each one, thus increasing ROA. And so our final objective in Chapter 7 is to analyze the cash flow impact of long-lived asset transactions. The three main types of long-lived asset transactions appear on the statement of cash flows, and they are acquisitions, sales, and depreciation. Acquisitions and sales of long-term assets are investing activities. The payments for equipment and buildings are investing activities that appear in the statement of cash flow. The sale of long-lived assets results in a cash receipt. Also, depreciation is listed as a positive item under adjustments to reconcile net income to cash provided by operating activities. And so this concludes Chapter 7 of our text, wherein we talked about plant, property, and equipment, the different types of depreciation methods, and then how the disposal of these assets impact the financial statements. We also talked about intangible assets such as franchises and licenses, copyrights, patents, and we talked about how we amortize those over their life. So next we'll go into Chapter 8, where we're going to talk about the time value of money. And so I'm looking forward to having that conversation with you all. So remember, read the chapter and work through the learning exercises, and don't hesitate to contact your professor or the course facilitator if anything's not clear. Thank you.